The coronavirus outbreak has made a serious dent in the way Filipinos consume space. Well, work from home and online distance learning seem to work for now. Well, we can't really Zoom a handshake or build long-lasting brands through clicks, can we? So how do you ride the wave until the local property market runs hot again? Joining us this morning, Rick Santos, Chairman and CEO of Santos Knight Frank. Hi, Rick. Good morning.
Good morning, Michelle. Great to be on your show today.
Great to have you. So what do you see in terms of the commercial market? I mean, we've heard from many CEOs, some are closing shop, others are looking at rationalizing and closing down stores that weren't doing so strongly even before COVID. And then you've got giants and multinationals like Facebook, for example, where half of the employees will be work from home forever. Does that hurt commercial real estate?
Yeah, no, it's a great question. I think with regards to the commercial real estate market, I mean, this trend is different. Having gone through 3 or 4 of these crises myself in different parts of the world, I think the commercial sector, I mean, as we know, the whole BPO call center shared services phenomena basically took off as a result of the Asian financial crisis in 1997, and that's the commercial office market here has been on a bull run for at least the last 12, 14 years. And obviously we were on a good run up until March 16th. So, and then obviously the world is in a pandemic situation. So this is since this is global, this isn't a situation that 97 is isolated parts of Asia. The global financial crisis in 2007, that was mainly a North American phenomenon, et cetera, which had effects that reverberated throughout the globe. But I think in terms of the Philippine commercial property market, I wouldn't write off the Philippine commercial property market yet. I think, in terms of office space, et cetera, call centers, shared service, et cetera, those are still going to be very relevant in terms of expansion. I think in terms of the market here, it's very different than, if you look at San Francisco or LA or London or some of these other global markets, infrastructure is different. Here, a negative becomes a positive. I mean, the internet connections here aren't great, so it is difficult to work from home. Also, people work in a multi-generational environment, so it's not always the best environment to actually take your Zoom calls or Teams calls, et cetera. So I think what we found is that the metrics working out of a call center or BPO in the office-based districts in the Philippines, the Philippines has some of the best metrics in the world. However, when working from home, the metrics are some of the worst. So I think my big view is that work from home really doesn't work. I think sometimes people like it for convenience, sometimes employees like it, there's no commute, et cetera. But in terms of productivity, just look at earnings of companies, et cetera, it's not going well. So I think in terms of productivity, and so much of the office space, especially for the millennial generation, which is the bulk of our workforce, of our workplace, the bulk of the population is about 24 years old. Millennials want to be in the office. They need to be in the office. They want to see their friends. They want to go around the water cooler, exchange ideas, et cetera. So in terms of workplace office strategy, that will all be reflected. So I think offices will still remain extremely relevant in the emerging markets, especially the Philippines. Very different than markets. If you're in Silicon Valley, or if you're in, or if you're in San Francisco, or you're in London or LA, pretty different, right? Infrastructure works extremely well. People in low density housing situations, et cetera. So office space, I think, will still continue to be extremely relevant from a Philippine perspective.
So what do you see over the next, say, 3 to 5 years? How will the dynamics change for office setup? Perhaps are you looking at hybrid, where you've got work from home parts, and then rationalized headquarters for presence and profile, and then perhaps local hubs? What do you see?
Yeah, I see some great opportunities. Clearly, the positive things like Zoom is you are able to dig deeper in your company and your organization, get through to a lot of people. You do miss that person-to-person interaction. However, from an office space perspective, I think, people might work in teams, an A, a B, a C team, et cetera. There might be more hubs, et cetera, to have hubs closer to home. But I think also probably a combination of high tech and high touch. So I think you'll see that clearly the commercial office is not dead, but also the technology will become a force multiplier. However, from a commercial office perspective, I think people will need to adopt greater space standards. So on the one hand, you might have half the people in the office. However, the space standards are such you need to have social distancing rules. So on the one hand, there might be less people in the office, but you'll need more space as well. So it's yet to be determined how that plays out. The market's in a little bit of a cryogenic state now because obviously this thing's hit, in March, and we're feeling the effects now. And we've had lockdowns and forced work from home, et cetera. So we are seeing subleasing space come on. We are seeing some pre-terminations. We are seeing some tenants take advantage of renegotiating their leases. So I think that hybrid model, that work from home model, I think it will be relevant. I think it's always been there. I think this is just sped up the model, but there is. It's the jury's out in terms of whether people are actually going to need more space or less space.
And this falling demand, do you think, for example, in retail, in malls, in the mall business, because of falling demand, sort of, do you think that tenants will now have the leverage over landlords? Because we've heard of inside stories before that big malls are able to demand, for example, for you to get a space in the crown jewel properties, you're going to need to be present in other weaker malls, sort of like a buy one, get one deal. That's going to change now, is it?
Yes, I mean, good point. I think from a commercial perspective, clearly, and also from a retail mall perspective, you are seeing the dynamics change from a landlord's market to a tenant's market. So there'll be much more flexibility, and we're already seeing landlords continue to work with tenants. I guess from a retail mall perspective, I think the dynamics there will change as well. A lot of those malls had been a large percentage of them were food and beverage, which had isolated them from some of the other problems global retail had been having. I mean, retail globally had been hit hard pre-COVID. But I think what you're seeing now is with the lockdowns and whatnot, people are slowly returning to the malls, and obviously other tenants, that they can't, they can't last for 3 or 6 months without having any revenue. So I think you will see a lot of chopping and changing, some stores going out, some F&B going out. We'll see new, stronger brands emerging. Great opportunity for people to grab that ideal retail space. But I think in that retail market, which had been very much a landlord market for a number of years, now we've become much more tenant focused, and I think landlords as well are realizing that the importance of e-commerce and technology. However, I think the shop's loss is going to be industrial logistics gain. We're already seeing globally really defensive categories, the industrial logistics warehousing space. I mean, look at Amazon, and look at the Facebook, and look at the Googles, et cetera. Amazon as well, you're going to need more warehouse space to feed that e-commerce, et cetera. So we're seeing globally a very hot market in the industrial and logistics space as retail continues to be under pressure.
And what about hospitality, Rick? I'm very curious because you're seeing a lot of the big hotels still closed here. They've been closed for months. Are you worried, number one, that some of them could actually go bankrupt, or two, that those hotels, the 5-star, 4-star hotels who open their doors as quarantine facilities, is that a plus factor, a negative thing when people hear that, okay, this hotel, it's a very expensive hotel that charges so much, was used as a quarantine facility?
Yeah, no, I think with regards to the retail sector, or sort of the hotel sector in general, it's been the hardest hit. I think when you have a one-day lease contract, it's tough. I think, and those are subject to travel restrictions and quarantines and whatnot. So globally, the hotel, resort, service apartment sector has been one of the hardest hit globally. And it will depend on when international flights restart. Will happen when it's easier to have international travel, when people won't hop back on a plane again. I think you are seeing a lot of repurposing. You talked about some of them used as COVID facilities. The hotels are converted into office space, other storage space. I see a huge opportunity for investors and buyers with a medium to long-term view, because the hotel sector was very rarely traded. In terms of your individual island resort destination, they're definitely getting hit hard because people can't fly in to get there. So I see huge opportunities in investors buying into that sector, potentially financing that if you can time the bottom per se. I mean, I know Bali's completely closed to tourists until I think January 1st now. A lot of U.S. markets are getting hit hard. Are people ready to hop back in the plane, et cetera? But at the end of the day, these markets will come back. It's just a matter of timing how long this crisis will go for and when people already start traveling again. So opportunities for buyers in the hotel leisure sector, definitely.
Okay, final question. Where are prices today? If you could give us a sense, have property prices sunk? And what do you think about getting back to pre-pandemic levels in the housing market, the property market rather? Is it going to be a quick trip or it's going to take some time? We're actually showing, Rick, I'm not sure if you can see this chart from your second quarter report, where we see America, North America, and Australasia becoming more resilient, while Europe and Asia saw average prime prices weaken significantly. In Asia, it's from 2.5% growth to 1.1%, and it's said that Manila is actually still one of Asia's top performers with Tokyo and Seoul.
Yeah, I think our global study, I mean, Manila had actually been a top performer.
Mm-hmm.
Clearly, we've seen, a market that's been pretty easy to read over the last 12 years. However, since March, things have changed. These indexes tend to be generally backward-looking, so we are seeing the market very much in a cryogenic state now. Mm-hmm. Landlords are trying to hang on and not drop rates. Sellers are trying to. I think you're seeing flexibility. I think you are seeing downward pressure on rents, and rents tend to drop first, and capital values tend to follow. Capital values tend to be sticky downwards. So in terms of, but we will see more pressure on is if you see job losses, or you see people unable to service mortgages, et cetera, or in terms of, we've seen a number of projects slow down, so that will limit supply on the residential sector. The global phenomena, though, is people, moving outside the main cities and moving outside the cities. So we're seeing that in California, people moving out of San Francisco or LA and moving back into the suburbs, or in London, out of central London and out into the suburbs there, London, if you were, provincial towns. So you also look to see a decentralization a little bit for people that say, hey, I didn't like basically facing
Mm-hmm.
that traffic, and I don't want to travel so much. So I think in terms of, there will be a lot of opportunities in this market for buyers, and definitely the residential market has very much moved from a seller's market to a buyer's market. I think buyers can choose to be more picky in terms of the developer they go with, the type of units, et cetera. Mm-hmm. So I think we will see a number of deals available there, especially in the secondary market, as you have a lot of overseas foreign worker buyers, et cetera, overseas Filipinos. If they lose their job in the States, you will see opportunities there. So you will see some gaps in pricing there. The real estate market doesn't trade like the stock market. I mean, you can see, you've seen the IL REIT raise a lot of capital, 2 times oversubscribed. You can see what the price of the stock is every day, and you have a number of other REITs coming in mm-hmm. to follow it to raise capital. On the individual residential market, I mean, you might have one distressed seller and 10 non-distressed sellers. You still get a lower valuation on deals. So there will be anomalies in information and pricing in individuals. So this would be great opportunities for individual buyers that have cash, individual buyers that have access to financing as well. We're also seeing a market that is going to embrace more overseas investors, more non-bank financing, more creative ways to raise capital, whether it's REITs or bond offerings, et cetera. So we'll see a lot of financial engineering coming in each mm-hmm. of the equations. So we see this as a very interesting market for buyers, for people that are cashed up. There will be liquidity in terms of people that need to sell. So we're seeing a lot of activity now. Mm-hmm. So we're busier now than we've ever been in terms of helping buyers mm-hmm. and sellers, and it's definitely a trading market like we haven't seen for years.
And busy is good. Thank you very much, Rick, for joining us this morning.
Very good. Thank you, Michelle. Take care.
Take care.